Welcome back. You're watching The Money Show, and it's time to get your mutual fund portfolio queries answered. And today I am joined by Shweta Jain from Investography. Shweta, good evening and welcome to the show. And just in case you're watching our show live and want to send across your questions, you can do that on our WhatsApp number, which is 8657974571. You can also email us your questions on themoneyshow@etnow.tv. So let's begin, and we will take Kapil's question first, Shweta. And he says that he is 35 years old and he wants to accumulate 1 CR in 15 years. He's been investing since last 6 months. Okay, so he's doing an SIP of 15,000 per month. The funds in his portfolio are Parag Parikh Flexi Cap. He's got UTI Nifty 50. He's got Kotak Emerging Equity, Quant Small Cap, Edelweiss Small Cap, Nippon India Small Cap. Okay, too many small caps in his portfolio, but then he has one large cap category, passive, and a flexi cap. Okay, Shweta?
Yeah, Kavita rightly pointed out. So Mr. Kapil needs to make just one small change, according to me. One is that is remove one small cap from his portfolio. So I would recommend either the Edelweiss or the Nippon small cap. He can discontinue whichever he likes better. He can continue that because otherwise the portfolio is quite well diversified. For his goal, however, he would need to invest 20K per month, considering this 1 crore is the future value. So this is something that he needs to sort of work towards. The sooner he does, the better for him.
All right. Also, he needs to increase the investment amount
To 20,000 per month from 15,000.
20,000, and that should be increased across these funds, or just in any of these funds he can do that.
So he can increase marginally in the UTI Nifty 50 first. So make that like a 6,000. So that's a good base. And the rest he could divide it among the schemes.
All right. So that's the new fund mix for Kapil. We move on to Ritika's question, and she says that she is 30 years old. Okay. After 25 years, she needs 2.5 crores. And it seems she's calculated the future value also of the requirement that she has, and she's investing in SBI Balance Advantage, HDFC Multi Asset, SBI Nifty 150 Index, and okay, she also wants to buy 2,000. She's investing 2,000 rupees in all of these funds. Okay, pretty young, Ritika. Congratulations for starting your investment journey early, and very good on the part of aligning your goals as well. 25 years and 2.5. I think age and time horizon, investment time horizon is on her side, Shweta. So she might have to just increase an investment amount as and when she can do that.
Yeah, so the value, what she's mentioned, 2.5 crores future value today works out to say 75 lakhs in today's value. For this, she would need to invest 14,000 rupees per month. So that is something that she would strive to, sort of achieve. The other thing that I see is there's multi-asset funds and there is a balanced advantage fund. Ideally, then if her time horizon is so long and her goal is this, so she has to increase her investment from these to equity. So ideally, I would stop in these two funds and invest only in equity because it is long term. Making sure that she has some emergency fund for the next 3 to 6 months of expenses. She should start investing in pure equity. So she has SBI Nifty 50, which is great. So she can make that as a core part of the portfolio. And rest, she could slowly look at flexi caps and then maybe mid and small caps as well.
Yeah, I was just coming on that part because looking at the time horizon she has on her side, she can go slightly more aggressive, right, Shweta?
Yeah, she has to, and she needs to if she needs to get to her goal. So,
Exactly. So a flexi cap and a small cap, right?
yes.
Going ahead.
Yeah.
Perfect, perfect. Let's move on. Let's take Rohit's question, and this question is coming from Bangalore. Okay, he wishes to invest 20 lakhs in mutual funds, and he wants to invest for long term, say 5 years, and he's expecting 12 to 15% returns. And the goal is retirement, and he already has invested 30 lakhs in mutual funds, in flexi cap funds, and multi cap funds. So we don't have the details of that 30 lakhs investment, but more 20 lakhs he wants to put in mutual funds. So I think barring those category, he can divide this 20 lakhs in other type of funds.
Yeah, so I would recommend, since he already has experience in investing in equity and he wants to go a little aggressive, I would recommend small cap and mid cap for him. And since there's no passive funds, I would like to add like a UTI Nifty 50 as well as a core part of the portfolio. While he has mentioned that he has flexi cap and multi cap funds, this would become like a pure large cap play because he does not control where the flexi cap and the multi cap funds are investing at any point of time. So UTI Nifty 50 can be 5 lakhs for sure. Nippon small cap 5 lakhs, Kotak emerging equity 5 lakhs, and DSP small cap 5 lakhs. This is the breakup I would recommend.
So Shweta, a lot of investors want to park in money in lump sum. If one has to strategize this kind of an approach for their investments or for their financial goals, it's not possible for everyone maybe to have that kind of money to do a SIP every month. If it's a strategy of lump sum, how do you strategize it? Okay, we've seen Rohit doing it 30 lakhs already in flexi cap and multi caps, and now he wants to put in more 20 lakhs. So for people who get money in chunks, maybe maybe the nature of work is such. How can they strategize their investment goals or their strategies?
So a good way for them to do this is by investing in a liquid fund of the fund house that they want to invest in equity. So for example, if you want to invest in say a DSP small cap, then the ideal fund would be a DSP liquid fund where they can invest the lump sum and then do an STP, which is a systematic transfer plan from the liquid fund to the equity fund. So if they want to stagger it, say for 6 months, do a 75,000 SIP for this amount. And that means that instead of the money being taken from the bank, which happens in the case of an SIP, the money is taken from the liquid scheme where they're parking the surplus. The additional benefit that the investor gets is that even the liquid fund is earning some return. Of course, not too high, but is earning some return. It's not lying idle. So that way it's a win-win and they stagger their investments over time. So it's not everything is invested on the day that they've got. So that's a good strategy for them to follow.
All right, let's move on to our last question of the day, which is from Prachi. And she's from Chennai. She has 25 lakhs through a loan. And she wants to put this in mutual fund for 5 years. And she wants to know how much can she earn or whether she can earn 9%. And what are the funds where she can park in this money. And uh, she would like to take a SWP approach to pay the EMI. Does that make sense? Okay,
Okay.
so to pay off her loan, she's taken a loan and investing that money in mutual funds. And via SWP, she would like to pay the EMI of that particular loan. Right, Shweta?
Yes, that's what she means. But
That's
I
what
would
she
not
means, right?
recommend. Yeah, I would not
Yeah.
recommend this at all. Like no scheme, not even a liquid scheme is what I would recommend because you should never take loan to invest. You're taking loans to consume something, that's fine because the money that she invests could go down. The rate of return, the rate of interest that she's being charged might be higher than the return that she's earning. So she'll actually lose money in the process. So there is definitely, this is something that I would never recommend to anybody.
Have you come across any client like this who's taken a loan to invest in the market? Is it is
Yes,
it is it a common strategy?
unfortunately, yes, unfortunately, I have, and I cannot tell you how many times people end up losing even like their homes over strategies like this. So I have seen really bad cases, and it doesn't stop at just mutual fund investments. It gets into stock investments, stock trading, derivatives. So this is something I definitely would not recommend. It's a slippery slope. So.
And look at the way even Prachi has thought about it. She wants to do an SWP and then pay that in the form of an EMI. A lot of thinking, I'm sure, has gone into this strategy. A little bit of thinking while taking the loan and maybe a repayment strategy could have worked for her better. Shweta?
So what happens is, for investors who've just seen positives in the last couple of years, right? We've seen and heard only stories of markets doing great and fantastic, and a 5%, 10% returns to 50% in the last couple of years, where schemes have given or stocks have given. Investors think that there is absolutely no risk in taking such risky decisions. And of course, she has thought through, and she has read so much, and she's researched so much, and come up with a wonderful strategy that I would invest and I would withdraw via SWP and pay something, right? That's fantastic. The only wrong part is taking loan to invest. Otherwise, this whole strategy is fantastic. That she invests some money, withdraws for her regular need through an SWP, and money grows there, and the SWP pays off their EMI. The only wrong part is that she's taking the loan, and that's a big wrong.
Exactly. So that's a red flag, and one shouldn't really indulge into these kind of strategies or ways out to pay off their loan. The right strategy is to first think through whether you want that loan or not, and if at all you're taking a loan, think about your repayment strategy. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio strategies today. And on that note, just in case you're watching the show live and you want to send across your questions, you can do that on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.